Good evening, everyone. A warm welcome to all the participants joining us today. I'm Akshara Menon from PMS Bazaar, and it's truly a pleasure to host this insightful session on the topic that every investor, beginner or seasoned, must understand deeply. Spot the trouble, the red flags in equity investment analysis. Today's speaker needs little introduction, yet deserves a thoughtful one. We are joined by Mr. Arpit Shah, co-founder and director at CARE Portfolio Managers Private Limited, founder known as CARE PMS. Arpit brings with him over 18 years of rich experience in the capital markets, backed by the rigor and the discipline of chartered accountant, a sharp instinct of an entrepreneur who has built scale straight investment decisions across cycles. Beyond markets and business, Arpit is someone who balances intensity with curiosity, whether it's playing cricket or lawn tennis, immersing himself into reading or reflecting on ethical and spiritual values. He carries a grounded, calm, composed, and holistic approach to everything that he does. That unique blend of athletic focus, calm leadership under pressure, and high risk appetite shapes his thinking as an investment manager. And today we got to learn directly from Arpit on something that's absolutely critical, how to identify the red flags in the equity investments. In the market full of noise, narratives, glossy presentations, and momentum swings, learning to spot it early signs of financial stress, governance issues, capital allocation missteps, and business model fragility brings it important to have a difference between the protecting the capital and losing it. So the session I'm going to empower with full of thoughts. So thanks for joining us, Mr. Arpit Shah. Over to you.
Thank you, Akshara. I understand some of the words were out of the box, and but from your heart. So truly appreciate. I'll just start with so good evening, everyone, and thank you for joining us. We choose today's topic very intentionally because in last 3 to 5 years have been extraordinary period for the equity markets. A strong rally, flow of new listings, abundant liquidity, and surge of first-time investors have created an environment where optimism has sometimes overshadowed the caution. In phases like this, it's natural for fundamental red flags to get overlooked. Rising prices of the stock can make an even weak business look strong, and the momentum often hides the underlying inconsistency. As long term investors, that's precisely when the discipline matters the most. In this session, it is about to bringing that discipline back to the center, not through fear, not but through clarity, and just not to avoid opportunities, but to understand more deeply. There is a famous quote from the Peter Lynch that you should know what you are owning, and you should also know why you are owning. Now the second question is, why do we need to have the red flag right now? Because markets are at lifetime high. But what I understand is that retail investors like you and me are not having surplus funds. And our portfolios, though markets are at lifetime high, our portfolios are yet to perform or yet to see the uptick. So what to do at this point of time? If in the hindsight you believe that you may have missed some of the red flags in your companies, then probably this session will help you to go check the fundamental of the company, identify the red flags, go deep dive, and if required, churn the portfolio. Because in every new market, every new bull run, new set of companies reaches to its new high. So that's why we choose this topic. And let me take you through the topic itself. What is the red flag? You see, what is that? Before I take you through the what is red flag. Uh, Let me share with you some the pattern how the retail investors are trapped. If you see between these two companies, Okay, the promoters have decreased in first company, a railway company, promoters have decreased their holding by 25%, which is of which around 15% is absorbed by the FIIs and DIIs, and public another 12 to 15%. However, the number of shareholders has increased from 3,40,000 to 20. So 9 times promoters are the public shareholder number of shareholders has increased. In last 1 year, there has not been any growth in the share price. However, what we believe is that if you have ignored the red flag in that particular company, you might have got trapped into that company. Then the reason to look into the financials. At the end of the session, we expect that there will be clarity and not fear. You will see that you may not miss some of the opportunities, but you will understand more deeply how to do the analysis. Recently, everyone is in the research industry is worried that AI may replace the research analyst work, but that may not be true, because research is not only about the understanding the numbers. It is going deep into the numbers, understanding why these numbers, and apply your own logic depending on the which industry, which sector, where you are investing, and then understanding the numbers. So that we hope that you will be gaining some of the this logical logical interpretation of the numbers through this session. As a disclaimer, I want to make it very clear that all the red flags are not fraud. Many of the case studies that we will be doing, ultimately it has proven that company was a fraud. But all red flags are not fraud. Red flag requires that you may need to study little deeper, apply your logic. So please make sure the companies that we are discussing are not the fraud companies only. Red flags helps you to understand that, okay, whether you should apply the logic, whether the chance you are taking, even knowing that red flag, whether you the chance investing into the company, you are taking the chance to invest into that particular company, whether it is worth it, or look out of the basket for another 6,000 companies are available. So you want to avoid a company or you want to invest into it. So again, I'm just repeating myself. All the red flag does not mean those are fraud company. It is just required that further a particular caution is required while going deep into the understanding the fundamental analysis of the company. There are two categories, two buckets that we have classified for the red flag. The first is financial red flags. In the financial statements, we have balance sheet, profit and loss statement, and cash flow. Each of the statement has their own weightage. In accounting, always there is a double entry system. So if my P&L is impacted, of course, it will have impact on my balance sheet, and vice versa. Similarly, cash flow is the most important thing, but it will give you the real picture of the company. So how to identify red flags in those financial statements, I will cover through a real case studies. The non-financial red flags are many. For the quick understanding, I have just broadly classified those into four categories. One is on the management side, which is inconsistent guidelines, related party transactions. Sometimes, in the corporate actions like mergers, acquisition, the reverse merger, there are a lot many cases where you understand that the company may not require the merger. Why they are going for the merger? So those are non-financial red flags which you should check and in the company to before investing. If your investment or buying price is right in the markets, based on my experience, I can share that probably 50% of your battle is already won. If your buying is right, you have already secured your downside, or if you have already secured the worst case scenario. Uh, One of the important red flag is the key management, including the auditors change. There is a changes in if independent directors and reason behind it. So I will cover all these studies through case studies. Let me take you through the first case study. In markets, we want to invest into growth companies, and it is like everyone in the market for all the markets. But whether that growth is great or the growth needs to be checked. I'm sharing one example, a tech company. If you see the revenue has grown from FY14 to FY19 in 6 years, their revenue grew 20 times and the PAT profit after tax grew from 7 crores to 80 crores. So 11 times. So fantastic company. One may say that okay, because of the lower base, they got a higher growth. For whatever reason, 20 times growth in the revenue and 11 times growth in the PAT makes it is a investable company. Now let us see whether that investable company is really investable or it is just there are some red flags appearing on the financials. If you see the growth in the revenue, the next question is where the monies are being deployed. So here in that particular company, their increase in intangible assets, they have in FY17 they made PAT of 129 crores. Of that, they have their intangible assets. So software has increased from 68 crores to 198 crores. So all 130 crores they have deployed in acquiring intangible assets. Now, whenever you are buying intangible assets, parallelly your assets or revenue should grow. Okay, that is why you are investing into into the fixed assets or intangible assets that you see the revenue potential. In the next year, you don't see any growth. In FY 18, FY like sorry, FY 18, FY 19, there is hardly any growth in the portfolio or in the top line. However, we believe that okay, this is something fishy because parallelly your employees are not increasing, your tangible assets are not increasing. Writing down a software a company, a very practical and very logical thing is that if I am running 1,000 crore company, for me, if I want to siphon some cash, I can buy a software of 5 crores or I can buy software of even 100 crores. No one is going to question me because it will be within the related party. There was an inflated sales from FY17 to 19, and we came to know because it was mentioned in the annual report through it was through related party, and then they wrote all the 559 crores of the receivables. At the same time, whatever their application of the funds was there, the computers in around 520 crores, they write return of everything. So these are the red flags. Once you know the growth, because even the fraud promoter knows that what is the expectation from the investor. They know the numbers, they will provide you the numbers, but you need to dig deep to understand what are the genuineness, what is the genuineness of these numbers. Between this period, growth period, promoter has decreased their stake. I think this particular line, promoter stake sale, is you will see in many cases in this upcoming slides, because there is a trend which we believe that because promoter is aware that okay, this is not sustainable, one day or other day my fraud may come out. Lately in 2021, just to encourage the I tech boom, company even changed their name to and include cloud into it. So these are red flags, uh, which we come to know while digging deep into the company's financial. One company raised the IPO. What is the reason to raise the IPO? That because right now there is a very hype of all the IPO, all the new listings, and all these things. So one of course cause is to for the growth. So when you are into business from last say 20 years, you anticipate that okay, I'm expecting 5x, 10x growth in next few years. And for that, I need to raise the money. That much basic understanding of the business is what we expect as an analyst from the management. As per SEBI data, this company had the smallest time gap ever between IPO and QIP. In July, they came up with the IPO of 400 crores. In the September 2016, so almost within 15 months, they they came up with the QIP of 500 crores. सो बेसिक क्वेश्चन इसके बॉस आपको पता ही था कि एक साल में और 500 करोड़ लगेगा सो इट इज मोर देन द इवन आईपीओ प्राइस देन व्हाई यू कुड नॉट रेज एवरीथिंग एट वन वन टाइम एंड द रीजन टू रेज द आईपीओ क्यूआईपी वाज द सेम just to increase in the growth opportunity. Company, while issuing the QIP, they already had 90 crores funds available, which they have raised through their IPO. So then also company didn't go for to borrow the funds, but wanted to go raise funds from the QIP. Now see the what are the what are the financials of this company. One more trigger was that next year auditor resigned because management failed to give the required answer. Second auditor resigned within 1 year, not allowing audit. So reason for the mentioned by the auditor was to not to allow auditor to enter into the factory. So in the if the multiple auditors can't say, investors shouldn't either. The financials of this company, they've also shown the inflated financials. They've shown the financials from because they wanted to raise the fund in FY16, FY17. They show fudge all the financials. Sales grew by 4 times in 4 years. EBITDA grew. However, ultimately it was found that company had a bogus firms, the prices bogus firms, and all the related party transaction got written off. Of this 270 crores of receivables, company had to write off all 268 crores. So the basic question, we avoided this company for the investment because the basic question came to us that why do a company need to raise the funds within 15 months if the company is into business from last 10, 15 years? And that is also amount which is more than the amount raised by the IPO and at the higher price. So these are the red flags. In the current scenario, you know the IPO markets are booming. Before subscribing, do deep dive into the financials. All the monies are very hard earned by every one of us. So just not to take, not to give the privilege to others to just use them for their own benefit. Focus on the source of profits. After the top line, our being an analyst is the profitability is the most important business, most important financial figure that one look into it. Here also there are two examples where the profit before tax. What are the profit before tax constituents? The one company is showing PBT. So this company, first company, you will see that after almost 6 years of their business, they have made the turnaround in FY24. Correct. From 1,000 crores of losses, they are having 291 crores of the profit. So markets में तो सब तेजी में आ गए कि wow, it is a profit after 7 years. Now that business can grow to new scale. Now all the profits will convert into cash. But if you check the constituent of the profit, it is through other income. If you remove other income, which is not up into business, you have a business loss of 500 crores. Again, I am not saying this is a fraud or this is some fudgy. This is just understanding what is the red flag. When you divide the profit before tax, when you remove the non-business items from the financials, then only you will be able to understand the financial of the business and you will be able to make your right decision whether you want to invest into company based on the profitability of the very much business in there. Another company, one of the largest dealers and tractor company, there also the profit PBT figure was there, But other income was also significant part of the profit. But throughout the journey in last 8 years, they have made profits from their own business. So you have two scenarios. In both the cases, one in first case you have a company. In both the cases you have a PBT which includes other income. But in one case PBT is only because of the other income, and in other case it is addition to the normal business profit. So these are the red flags which one needs to understand before investing. Then why do you raise the funds? What are the objective when you are raising the funds? Here also one company got listed. This is a very long story, but I'll cut it to few slides. That this company came into existence because of the reverse merger. So only thing that we understood was that this company actually does not need to raise any capital because their business is in such a fashion that their working capital requirement is very negligible or very nil. There is no requirement of fixed asset. But we understood that okay, company has something. There are some red flags because management is decreasing their stake, though 30% reduction in promoters holding, 15% has been absorbed by the FIIs and DIIs. But the biggest trap was the public because their number of shareholders is increased from by almost 10x in last 4 years. So these are red flag. You understand the company, public. You if you follow the FIS DIS blindly, these companies right now and don't understand the why the company needs funds, you may fall into trap. So these are the red flag. So in the same case, the similar case where you see the promoter shareholding is decreased from 50% to 22%. So 28% of the promoters stake is decreased. But if you deep dive into it, you will understand that what this company was having 30% holding by a private equity player. In the earlier case, it was promoter themselves who were who were exiting from the company. In this case, it was a private equity which was exiting. So for this company, though it was a red flag that who is exiting, why is exiting, why they are raising the funds, why they are coming up to IPO, coming through an IPO, it was very logical in this case that okay, private equity has a tendency to exit from the company in 9-10 years, and it was reasonably valued. So we also participate in this rally, and still at even today's market, it is at the lifetime high. Here, the number of shareholder has been decreased, though promoter shareholding has also decreased. In the earlier case, it was absolutely reverse thing. The third red flag you will come to know from the diversification. Very famous quote from the Peter Lynch only. He only mentioned this word diversification and not the diversification. Uh, when your business is making good money, it is always the allocation of the funds which draws attention of the analyst, including ourselves. Let us see the example. Two companies, established business of 40 years, they both are having good cash flow, both are having good revenue, top line, bottom line from their existing business. And for the growth, each and every company wants to diversify, which is quite okay as far as we are concerned. Company has to take some chances, company has to take some trial and error in business to grow. If they don't do, we will also punish them because they are not allocating their capital properly. But what are the reasons for diversification? In one packaging company, laminating company, they diversified into pet care business. ओके, लेट अस एक्सेप्ट कि ठीक है ये कुछ नई अपॉर्चुनिटी है, बट व्हाट वाज द रीजन बिहाइंड इट? द रीजन वी केम टू नो was promoter's daughter had a strong interest in this sector. At the same time, one more company into textile company, there also second generation took over as the management. They also wanted to diversify from from fabric company to a technical textile company. And you see the results of both the businesses. In one company where it is absolutely irrelevant diversification based on the promoter's daughter had a strong interest, you see the complete revenue is lost. And on the other hand, when it was based on the merit, you see the difference. The company that now that company is getting major part of the profit through their advanced technical division, advanced material division. So these are red flags where you identify where companies are diversifying and what are the reason for the diversification. Next, I will take this is also very interesting and recent case study because in as far as CARE PMS is concerned, for us, two things are non-negotiable in investing. One is the financials, second is the management. And how do you judge the management? So one management into EMS company has changed their guidelines. Now, what is the red flag in that guidelines? The company is giving guidelines on 12th May 2025. Okay. So 12th May, that first quarter runs from 1st April 2025 till 30th June 2025. So 90 days. Company is having conference call on the 45th day. So you have already passed your half of the quarter. And that time you are giving the guidelines. That you are mentioning that early arrival of the monsoon we are anticipating, my pet can be 400 crores. First of all, we try to see that management don't give guidelines for the profitability. They can mention the margin but should not mention the numbers. But this is one thing. They mentioned the numbers, it is okay. In next quarter, after this Q1 is over, the second quarter con call, company has revised the guidelines from 400 crores to 300 crores. So almost 33% reduction in the PAT. And the reason they said the same, that okay, company was monsoon has arrived earlier than the usual one. So these are the red flag about the management commentary. If I am sitting today at the end of say November, and I'm giving guidelines for the quarter of October to December, I already have passed two-thirds of the revenue. I should be at least honest on my guidelines.
Yep.
After the management revise their guidelines, we see the sharp fall of almost 40% in the stock price. Coincidentally, management also reduced their holding. Here, the important red flag was that when you know that your macro environments are not good, you are giving guidelines that okay, early arrival of monsoon, your sales is on of the air conditioner, and you may see some impact on the sales. Then also management is giving good guidelines. So that is a red flag that you should be alert. Let the company deliver what they are anticipating, and then buy the stock. Don't jump based on only guidelines. One interesting case study I will share is personal interest versus company's interest. Uh, I mentioned few slides back that understanding the financial is one thing, but financials interpreting financials are more of an art. And this is because for each of the industries, there can be different financial parameters. Like in companies where you have a perishable goods, you will see the lower number of working days cycle, where in the other companies where you see they are dealing with the government contracts, you will see higher number of working capital cycles. In this company, this is into a textile company. This was into textile company. In India, we have a tough funds, TUF, tough textile upgradation funds, which lends to the textile company at very reasonable borrowing cost. Now let us understand the financial of this company. This company has total debt of 125 crore in FY20. They are paying almost 8% interest cost, which is fine. On the face of it, it looks very good. However, in FY20, the promoter has lended 27 crores. So out of this 125 crores, there are 27 crores which has been borrowed by the promoters and at the average interest cost of 14.5%. So you have tough available. Then you have banks where you can borrow the funds. There are other borrowings at 6%. However, the promoter borrowing interest is at 14.5%. So when you deep dive into annual report, you understand the related party transaction. You do your back of the envelope calculation. You understand that these are the red flag. While company can get the borrowing at sub 6, 7, 8%, 10%, promoters are giving funds at 14, 19, 15% of the interest. These are red flags. One can avoid investing into this company because here the integrity and of the management is at question. Though on paper it may not sound like a fraud, but there are another 6,000 companies available in the market. Why to invest into companies where you see that there is a problem? Here, the management remuneration is a pain area. Uh, Almost so where you have net profit after promoter remuneration only, but 25% of the PBT in FY21 is going to the management remuneration. Uh, so here my colleague Neved has written very nice quote: when the left pocket does not business with the right pocket, investors should be skeptical. So these are red flag. Now, uh, understanding the dynamics of the business is far more important than the number analysis. This is also very good case study of understanding the red flag in particular company. In analysis, every one of us are doing peer analysis, right? What actually other players in the same industry are doing. Every company has their own different business line. They may be having their different USPs, but fundamental nature of the business may remain the same for the industry. In the dairy business, it is very perishable product. Shelf life is hardly 7 days, 8 days. We went through the investment. We went through one company where their inventory days, their receivable days are very high. So in those cases, what happens is we went to see the management and we asked them, "Okay, what is the reason?" They said that we are having higher weightage of the value-added products. So higher having the value-added products, it is fine. But that was a red flag because it is a perishable industry. In FY22, the company wrote down around 500 crore rupees worth of the inventories, and the market price has also seen very sharp downfall. At the same time, we have seen the parallel CFO has resigned. Their annual announced delayed result in Q4 25. The company, as I mentioned, they declared inventory write-offs. So while having the peer analysis, you understand where is the red flag. Company is still there in the market. It is freely tradable, and you will see some very large investors into it, large, very well-known investors into it. But we avoided citing the red flags of the company in the financials. Misuse of the borrowing. This is very interesting. And last slide about the case studies. Uh, Here, one engineering company and one tea plantation company. You will see both the companies are increasing their borrowing. From first company, engineering company has increased their borrowing from 180 crores to 680 crores. In another company, their borrowing has increased from 900 crores to 1900 crores, 2x. But The reason, the red flag is you apply your logic that why a tea plantation company may need to borrow the funds because it is dealing into agri commodities. Their cash flow is different than what the engineering company may require because they will need a fresh front loading of the capacities. While the engineering company borrowed the funds, you will see the parallel increase in their fixed assets. Their fixed asset has also grown almost 8x. At the same time, the tea plantation company borrowed the funds and lended to their promoter to their group companies. And the reason for that was all the juice business were not able to borrow from the market. So this being a parent company, being very large company, being the largest plantation company in India, they provided corporate guarantees and they borrowed the funds and provided finance to those companies. Ultimately, they had to make provision of 110 crore in FY23, and company has actually become the bankrupt. So you see the same trend in both the companies where the borrowing has been increased, but when you apply your mind, so this is a red flag, but you apply your mind, you see, understand the company nature of the business and the industry. You see that there is a misuse of the company, a misuse of the borrowings, and you can avoid falling into trap into those companies. Non-financial matter, you see some companies, we have seen the independent director resignation. There are frequent changes in the auditor resignation. Fortunately, in last 3 4 years, government has mandated that anyone is resigning from the company has to give the reason, proper reasoning has to be there. They just can't abruptly resign and say nothing. So we know, we go deep dive and understand what are the reasons, and uh, then you probably come to know that whether there is a red flag or no. This company came into SME IPO in August 2025. However, few months back only, back to back, you see there are two auditors' resignations. Though it was subscribed almost 8 times or what, something like that in the pre-IPO boom, but we found that this is a red flag and avoided this company. So, friends, I am ending all the case studies with this. Most case studies that you saw today are the stocks we consciously avoided either by exiting early or not entering at all. And most of the companies comparison that you saw were the companies either we bought or we are still holding. At CARE PMS, we focus on what most of the layman investors miss. That is early sign of governance discomfort because we could go deep dive. We have all the infrastructure available with us. We are total team, dedicated team into research. Subtle crackdown behind the numbers. Why these numbers? What are the silver lining between the numbers? Uh, what are the shareholders doing? What is the promoter's interest? And whether capital is being used wisely or not. In our legacy, we are able to generate around 21% CAGR in last 14 years. You can contact our marketing team to know more about us. Uh, what we believe, and as I mentioned in the very first few minutes only, that today market is not broader market. You see the portfolio index is at lifetime high, but broader market is missing the rally. So it is right time to see the red flag in your portfolio holdings if it is there, and churn the portfolio to participate in next bull run. So, friend, with this, I end my presentation and I open for the Q&A. Thank you.
Thank you, sir. I think that was an insightful presentation. I would say, like, is there any idea of being a professor any day, sir? If not a fund manager today? I
I am
felt
very much interested to in the teaching line, but somehow the time bandwidth is not there.
yeah, seriously, I felt I was in a master class. I think any equity research analyst, like, if they're aspiring equity research, like, and if they want to see this webinar, I think he has got what he wants, to be very honest.
Thank you. Thank you. The credit goes to our fund manager, Mr. Jayant Vaman here. We have learned from him only. So just wanted to mention his name. He is the pioneer of identifying the red flags.
Seriously, I think people generally pay for such master classes, and you're given the market then free of cost actually today. Thank you, thank you, sir.
Very kind of
And
you.
meanwhile, all the participants, if you have any questions that you want the CAR PMS to answer, you can put this on a Q&A box. We will take it forward. So before giving, the podium to other audience also, let me take a few minutes of yours. The thing is that, so whatever we spoke today, like about the fundamentals and how to look into the balance sheet and what are the, criteria that one should understand about the red flags. Yeah. So these can be automated at one point of time. So we have AI coming in, disrupting every other
Okay.
sector today. Correct. So tomorrow, AI can replace the fund manager also. So don't
Yeah.
you think there's an app that can, replace this fundamentals and make it easier?
No, no, because one shoe will not fit to everyone. Every industry, every company, you need to study differently. A
Mm,
company falling into textile industry cannot be measured on the same parameter of the company dealing into dairy industry.
true.
Uh, so and the growth aspect of each companies are different. There can be a number of events that can
Mm,
happen in a company which will be very subjective to that particular company. Like if particular plant is shut, so that may impact a particular company only.
okay,
Correct.
so
So it cannot be automized. I don't think it can be automized. What you numbers you can just the general getting the idea of interpretation of the number is different thing, but going deep into it, it is very subjective, and for that you need keen interest into it first of all, and you have to define it very well whether it is important or it is not important.
okay, so it's
In
basically
many cases, we have seen in my career, we have seen many cases, many red flags where the auditors have given qualified report. But then also we believe that okay, these companies are good, worth investing, and we made 4x, 5x in particular company.
got it, sir. So it's like, even the human exists, even the AI exists. It's like we are
Yeah,
both
it can be.
in that manner. No one can replace anything.
No, no, no. Right. It is not possible. Research
Okay.
is full of art and science. So science can be taken over by AI. Art still will be with us only.
True. That's true, sir. So like we spoke about the red flag from the stock level. If I have to ask, regarding the portfolio level, so if there's any red flag, an investor should check on his portfolio level. So what would that be?
So at Care PMS, how I will share with you how do at Care PMS we do. So our flagship strategy is growth plus value strategy. Okay. So we in a quarter we analyze say 50, 60 companies in deep analysis. Okay. So at portfolio level, we make sure that my portfolio is not tilted only towards the growth companies. It is balanced of growth as well as there can be the value stocks. My portfolio is not tilted only towards the turnaround companies. So at the portfolio level, this whole alert you have to be there because some companies may see poor liquidity. If you are in need of cash, you may not get exit. So portfolio structure also there can be many red flags. It should
Mm.
not be biased or tilted towards particular segment. So to mitigate that red flags, what we have done is we have prepared a very specific framework where we will not have a higher exposure to particular industry. So say 20% in particular industry, even though we like that industry. In particular company, we will not invest more than 12%. Portfolio will always be blend of growth as well as value stocks. So yeah, so there is a portfolio level one can look into his portfolio as well.
Yeah. But that, when in markets give negative returns, so does the portfolio also. Yeah. So that's where the drawdown part comes in. So how do you see that part?
See, correction in the markets are inevitable.
Mm.
Okay, and market when market corrects, each and every portfolio will see a drawdown. What is more important is that how you are participating in next bull run. Okay, so as we are seeing in small cap and broader market, they are still underperforming in last since last 1 year. So of course, this broader market or this large cap rally will definitely flow into the small cap companies. Okay. So today is the time to churn the portfolio to participate into next bull run.
Okay.
People are staying invested into their portfolio companies only based on their hope that okay, मेरा company का 100 का P मिला था, it was justified, or 100 rupees was the price, it was justified. I will wait, though it is right now at 40. I will wait it to again cross 100 rupees, which may happen, which may not happen. But if you are churning your portfolio to the companies which are having merits, there are bright chances that in new bull run your portfolio will cross new highs.
Okay. So when you say that, people can look at the next bull run and all. See, when you find a red flag and correction comes immediately to the market portfolio, the stock or something. So and markets are very impulsive. They don't wait until the next. Investors also won't wait until the next bull run. So if how do you see the company update that you take under this?
In our previous webinar with PMS Bazaar, I shared that portfolio construction strategy at different market phases has to be different. In bull market, extreme bull run market, you construct your portfolio differently, and extreme conservative market, you construct your portfolio accordingly. So at CAGR, what we did was we exited from some small cap companies and gave higher weightage to the large cap companies, which we are now turning to other side. In the layman language, I would say that investors should look for 4 to 5 years time frame in mind. In 5 years, there will be 1.5 year of correction, but there will be 1.5 year or 18 months of bull run as well in 5 years. What are the when is the right time is not the question. Even Mr. Warren Buffett can't answer when the market will fall or when the market will rise. But 4 or 5 years is good enough window one should give for the investment.
See, none of us can time the market.
No one.
That's true. So my next question is how to differentiate a company with a red flag but still appears, worth investing it. It will be helpful if you could take an example of such kind of a company. So 1 second. I'll just give a proper disclaimer saying that any stock that he is going to take it is nothing to be considered as an investment advice, either from PMS Bazaar or not from CAR PMS. Yes, sir. Over to you.
So red flag I discussed in our presentation only one company. They are into auto ancillary. Their red flag was that the company is seeing the promoters are reducing their stake in the company. At the same time, all the top line, the growth was coming. It was coming through acquisition. So those two were the red flags in the company. However, we went to Bengaluru and met the management, understood the concept, why all the growth is coming through acquisition only. So, and what is the game plan of the company? So, from the promoter's perspective, it was appearing that one private equity wanted to exit. Private equity helped promoters to build this company from scratch to almost 80-90 crores of the top line. And then after 7-8 years, they wanted to exit. So it was a logical interpretation कि okay, private equity जा रहा है. After three promoters, one promoter died, and the second generation didn't want to continue. So their exit was also logical. Okay, then they probably get the exit through listing. Now the second part of the question was why all the growth, top line growth or margin is through acquisition only. So when you understand the acquisition, we understand the business of the company, that all the acquisition they have made, they all were very niche into their technology. Like one company was having a parent company of the German. In Germany, company went bankrupt, so they wanted to dissolve their Indian arm, and this company bought the stake of that company. Okay, so that technology was only available with that company, the acquired company, and this company bought. So it was very logical कि ठीक है, इसके पास एक नया segment हो गया, एक नई technology हो गई, which they can encash, they can push the same product to their business. Is already added the top line, and all the acquisition were EPS accretive.
Okay.
So ये सब रेड फ्लैग्स थे. We
Yeah.
क्योंकि अपना what is the red flag that you are not growing your own business, existing business you are not growing. Whatever growth you are bringing into business, it is only through the acquisition.
Mm.
That was the red flag. But we invested at somewhere around 400, 500 rupees. Today it is at 1800 rupees. And still we are invested into it.
Okay, sir. So when you say that you want to talk to all the promoters and you are understand about the company, don't you think that you'll be fluid away by the biases in that sense?
Bias is always about we want promoter to remain invested, right? So we want they are interested into their business. Of course, their professional management are welcome, but if promoter is there, nothing like that. In fact, for all the companies, we want that promoters are personally interested into the business of the company.
Okay, correct, sir. And let's talk a bit about macros as well. Like spoke about portfolio, we spoke about stock level thing. Let's talk about the macro level aspect as well. So we have the T factor that's coming into the market now and then. So is there anything else the investor can expect out of the market?
In last broader market, so my expertise is only limited to Indian markets, and that is also listed space. I am not expert on the global market as well as currency, gold, IPOs. I don't have any knowledge of all these things. Indian markets in last 1.5 year is seeing the good correction. I believe the liquidity is still there. After almost 4 quarters, this quarter's results are better than expected.
Okay.
So we believe the next bull run may start in somewhere in 6, 8 months from here on. So that is the macro outlook on the markets. So probably the broader indices may see the sidelines. The index or Nifty may see the sideline. On company specific movement, you will see 20-30% jump in the company's market price.
Yeah. So when you say that, next quarter results are expected to be quite, supportive. Yep. Generally, what happens is that in the past years, if you could see, Q3 and Q4 results are always quite supportive because of the festive season is beginning, with all the
Correct,
Diwali
correct, correct.
coming in. So the purchases are more. So that the fusion of money into the market is more, infusion of money.
Correct, correct.
So, but is there the only reason to have, Q3, Q4 results positive?
No, I said Q2 was better.
Oh, Q2 is
So
better.
Q2 was better. Q2 was far better than what we anticipated.
Mm.
And the credit goes back to the 2024 election because in the previous Q1, Q2, we had that election like. So Q2 FY26 results were far better than expected. And there is enough after 4 or 5 quarters, we are seeing some traction. So
Okay.
probably the rally should start soon.
It should start soon.
Yeah.
Because, moment when you say small cap, yeah, small cap investing, the investors first, thing that comes into the mind is, their interest to invest. But the thing is, when will it run? When will it have its bull run? When it will have its momentum is always a question. So if you want to answer that part.
Yeah, one should have 5 years time frame in mind. Even if I would have known which companies will have good momentum, I would have been a billionaire or multi-billionaire right now. So no one can time the market. In the small cap, if you don't go deep into financials, don't go deep into the fundamental research, then I would recommend to go with either with the expert or through the mutual fund. In small cap space, we find lot many red flags in many of the companies. So just to gain some few 10-15% extra, don't do it on your own. It may cost you 50% of your capital.
Okay. So when you say that, let me take one question on alpha generation part. Yeah. So of course, in one of your PPT, when you slides, you just mentioned that, Nifty is at all-time high. It's seeing new highs actually. We are in about 26,000 levels today, which was not the case like few months back. So, but the portfolio, that the alpha generation there is still limited. Nifty तो चल रहा है,
Yes.
लेकिन portfolio नहीं चल रहा है. So if this question that always prompts into investors' mind. So if you would answer that.
We are getting too many memes of it. Portfolio.
That's there.
That is an always trend. That is always a trend. I am into market since 2007. In fact, 2005. It is all from last 20 years. I have seen the same thing. It is the patience which will be paid off. So you have to wait. If you just have to be make sure that your underlying assets are good. That's it. Market will value your company at their own time. It may happen that in small cap, while interacting with the client, I say that okay, my if my target of say 100 rupees ka share price will go up to 500 rupees.
Mhm.
Okay, in say 4 years. So for 3 years and 9 months, you will see the movement only between 80 rupees to 120 rupees. And in next 3 months, it will cross from 120 to 500 rupees. So this is the movement of the small cap. If I know when is that these 3 months will come, then probably मेरा portfolio कुछ अलग ही level पे होता है.
So I think none of us can even time it. You're not machines, or even machines. Even for machines, it's difficult.
What you can do, what investor should do at all the times in the market is just make sure that he has remained invested into good companies, and the buying price what he's paying, it is reasonably valued, if not very cheap. Those two things which one should monitor, and he should continuously monitor. And
Got it.
if one of these is not fitting well, then probably churn the portfolio. There is no harm in booking losses. At Care PMS level, we have number of incidences that we have booked losses, huge losses into the portfolio. But that has helped us to generate liquidity required, invest into new companies, and see our portfolio grow in the next bull run.
Okay. So I think we've heard a lot from stock analysis to the portfolio analysis, also a bit about macros as well. And of course, there were few questions from audience. I think Nived from CAR PMS has already answered them, and it made my work a bit easier today. Thank you for that. And also, I think for this, we can come to an end for a complete session. If there's any questions, I would request the audience to, put it forward to, info at PMS Bazaar. So those questions will be given to CAR PMS, and I will request sir to, take some time to answer those questions as well.
My pleasure. Sure, sure. Thank you, PMS. Thank you, everyone, for joining this session. And do let us know how we can be of any help. Thank you.
Yeah. Yeah. So thank you. Thank you, everyone.
Thank you, Akshara. Thank you very much. Thank you, team of PMS Bazaar, everyone.